Welcome to the Brew. Today's Traders Workshop. We're live. Guess what? Christmas comes early. Options unwrapped. We're going to look at packed strategies today. What the hell does that mean? Stay tuned and we'll get into it after the bell. I got to tell you, it's such a Yellowstone tune. I don't even have a cowboy hat. I couldn't find it.
I was about to say, that's a fedora.
It's a fedora. It's not a cowboy hat.
Into Panama, buddy?
It's not even a cowboy hat.
That
was Florida. I don't know what the hell that was. Good morning. Okay, we got to get to it. We're late. Let's get rolling. Jason's got a new background, which isn't a background. I don't know what the hell's going on.
Oh, this is. I'm not in my office right now. I'm in my wife's office because my computer broke. So
yeah,
I've got to use her computer.
Okay. I think this is going to be the Mark show today, and Jason, you're going to chime in, but I think it's going to be the Mark show.
Yeah.
So,
Mark, plenty to chop it up here about.
Yeah, we got to chop this up. So we're talking package strategies, and let's kind of talk a little bit about the ETF world and the benefits and drawbacks there, perhaps, and what this package strategy means. Because you and I had a little chat about this the other day, and we thought this would be a good topic today for folks to understand. So let's do it. I don't even want to say anything more. Why don't you lay it up here a little bit and explain it a bit?
I'll put out two disclaimers first. Beyond, I'm a financial advisor. This is not financial advice, yada, yada, yada. But with regards to ETFs, one, I love them. I think they're fantastic. This is not a knock on ETFs. ETFs are a brilliant innovation. So many great reasons for them. Absolutely, true financial innovation up there with the ATM. Number two, I love that more people are trading options. I love that more things, funds, entities are getting involved with options. That's fantastic also. That's great. That's great. That's great. The two together, though, that's where I have beef. And I think that's where we need to talk about, or what we need to talk about today.
Okay. So, all right. So the package part of this sounds like some smarty pants in a lab somewhere decided to package an ETF component and an options component into a product, and you can buy the product that can simulate a covered call or something else. Is that kind of what we're talking about?
Disclaimer number 3, covered calls are great. I love the covered call strategy. So, this is not a knock on the covered call strategy or packaging, but I think where the difference lies, and I think the main difference, we can get into some of the other details, but stocks you can buy and hold. Stocks, set it and forget it, get the equity risk premium for, 5 clicks and you're set for life, basically.
Right.
Like stocks go up in the long run as long as you're willing to hold. That works perfectly in an ETF. Tax advantages, like all that great stuff. Like that's why that works so well. Option strategies, you can't just do the same thing all the time. Like the options bend and wiggle in ways that require you to dynamically manage them. Expiration, assignment, settlement, rolling, all that. But like, is vol high or low? Like that's a second order thing that's not just, sell calls because you got VRP.
Okay.
There needs to be management with them, and you can't just set it and forget it with a covered call or any option strategy.
Okay, so Jason, do you have any thoughts on this so far? The package part of this thing, we haven't.
I 100% agree with Mark, and honestly, it's not even just the ETF space, but I run into all the time so-called income traders who basically are selling premium. Both puts and calls, the goal is sell premium, collect VRP, and you make money in the long run. Unfortunately, there are volatility concerns, expiration concerns. There are options are the tool of, they're like the Swiss Army knife of the market. You can trade on a bunch of different things, little scissors, little knife, little corkscrew, Equities is just like a hammer. You can do one thing with it. You could buy the stock and that's it.
You could sell it.
And you could sell it. That's it. You could buy it and sell it.
Two-sided hammer.
Yeah, two-sided hammer. But
I'll bring it.
options are so much more nuanced, and it accounts for so many different variables that you can't just do, you can't use the Swiss Army knife like a hammer all the time. You have to account for every component of it. So I agree with Mark wholeheartedly.
Yeah, and Mark, you and I talked about this. I think we're all in agreement on the package product. Can you lay out though how would this package product look to a retail client or someone who would use the product? What is it priced? Does it say, hey, I'm a covered call? Is it an ETF? What's the word for it? And how do I buy it relative to pricing? And which strike are they using, for God's sakes? Do we even know, or is it a percentage return kind of a number? So what are the dynamics of this thing, and how do I find it if I wanted to make fun of it and poke holes in it?
Well, that's the best reason to pull one up. This gets meta, and maybe there's the 201. You could trade covered calls on the covered call ETF.
That's crazy. We'll talk about that maybe later, but that's a good.
That's a teaser for the future. Yeah. But there are a number of different ETF firms that are putting these out, and don't want to pick on anyone in particular. But they have like a NVDY or a TSLY that sells covered calls.
So that's a Tesla. The TSDY,
TSLY.
So that's Tesla, and that's if you buy that entity, you're essentially buying Tesla stock and a covered call as a package.
Well, you're buying the fund, and the fund is actively managing this strategy. And
okay, so you don't worry about expiration, pin risk, none of that.
No, you just worry about your capital evaporating.
Okay,
because they have broad amounts of discretion for what strikes they're going to trade, and I get it, right? It's really hard to put a specific formula of what you're going to do, what's going to be listed, but a lot of them tend to, under the hood, target a premium amount and target a distribution amount. Mm-hmm. And that's one of the really tough ways to trade options, because it means you're selling a ton when it's cheap. If you want to hit a 5% return or an X% distribution per month or whatnot, that means you're selling more options when vol's at its lowest or closer to the money, or however you want to manage that. But what ends up happening is they're just a massive erosion of capital, because they're distributing all these, cash flows from selling the options. It's not income. It's not a dividend. It's not rent. It's they're just distributing capital from, losing money selling options.
Sure. But the Tesla, we'll just stay with that one because it's pretty popular, I suppose. It fluctuates in the market, right? And what causes it to fluctuate based what Tesla's doing relative to that covered call that's in the package?
Correct. You can look up what calls they're short and whatnot. You can look up what the actual position is. Okay. And that's kind of a favor to the market makers, right? To the equity market makers. They have to know what's under the hood as that, active ETF is changing. Otherwise, they're not going to be able to provide good liquidity.
Okay. I got it. Interesting.
And so right now you can look up, I should know exactly what they're short, but you can look up exactly what Tesla call they're short. So is that, wiggles with vol and stock price movement, what their NAV should be.
So, but if the fund manager, of Tesla, let's say, I'm not sure I'm saying that right, that option that they are short in this package has to be rolled at some point.
Correct. And
so go ahead. Sorry.
I was going to say there are a bunch of different ways they interact with the market. And that's kind of one of my other second order knocks on this is the execution of these is much worse than you would actually get as a retail person. You think you're actually going to get something good, but a lot of these go through flex mechanisms where there's no competition on the order. They're trading wide markets, smacking bids, they'll do these as package trades that end up getting worse price because you're not trading in the lit public markets.
So when they do a flex though, so they create a unique strike potentially, and send that to the market making community to get prices on it, on the flex part of it.
In some cases, I'm not saying Tesla specifically does this. I don't know about them, but that is one of the mechanisms. You trade in the open market too, of course. I think in some of the more liquid options, they'll often do that, or they shop around upstairs, cross it with market makers. There's QCC. There's all kinds of ways to.
Right. So is there an advantage in your guys' mind to to a very beginner retail person who doesn't understand the covered call so much and when to roll and what to do and roll up, roll out, take the profit, blah, blah, blah. Is there any advantage to someone like that trading this? Or is it just not so good, period?
It
Be honest.
It
Tesla's
seems
not
like
going to get at us.
it seems like an interesting idea, right? Like I said, I love covered calls. I love ETFs. Like that seems like a good thing. It's just really difficult to implement in, a fun style way. And I think it could use a little more sophistication. So I think I have to say no.
No. Okay. Jason, any thoughts on this relative
I
to
would also agree on no. I would also agree on no, because number one, for all the reasons Mark said, just, functionally,
yep.
But ultimately, with Tesla, especially which can have outsized moves on both sides, you are, when you're doing just a mechanical covered call strategy, you are not realizing all the full gains, but you are realizing all the possible losses. So, because there's no put protection, it's just covered calls. So, I mean, ultimately, if you are that much of a beginner that you don't know what a covered call is, I would contact a financial advisor.
Do you know anyone? Do you know any of them?
I know a couple.
Financial advisors?
I know two, actually.
Name two.
The first one I know is Harvested Financial.
That's the guy, redheaded guy down below.
Yeah. Where's the ding? Where's the ding?
Oh, Harvested
and
Financial.
The other one is Ad Funds, which
no one's gonna be able to spell that except we Catholics. ADDEUM, I think.
Yeah, that's it.
Dang. Okay.
There you go. But
two financial advisors.
But not only those, I mean, we're financial advisors who are very well versed in options. So I mean, if you want to get into an option strategy, make sure, no matter who it is, other than all ads aside, no matter who it is, make sure that they are experienced with options in one way or another.
Yeah, and you two cats, I will give you the ding ding. You are as experienced as you can be in options, which is bravo. But you don't wear cowboy hats like I do. Anywho, so okay, back to this.
You spent enough time knocking them. I actually have, as Jason's comment made, I had a chance to look up their holdings. Okay. And to your comment about how volatile Tesla is, there's an interesting thing we can learn about their holdings.
Okay.
By looking at them. So they're not necessarily long the stock. They're long T-bills and poor man's covered calls, basically.
Oh, interesting. So let's define the poor man covered call, because that's another thing for some of the beginners who watch to understand, because I think it's a pretty good use of capital to be able to perform this one. So lay that one out, Mark, if you will, since you brought it up.
Agreed. It's a very instructive position here, right? That rather than, traditional covered call, own 100 shares of stock, sell one option.
Right.
The other way you can have that sort of exposure where you have delta exposure and the overwrite, volatility risk premium on the upside is through basically a call spread. And you buy a deep in the money call to function as your stock and sell a call above that.
Now, Yep. Sorry. Go ahead. I was going to ask a question, but if you're not done, go ahead and finish. Sorry.
You could do it in the same month, I was going to say, or as they have here, they actually have a split month. And so they're long the 295 call in February, and they're selling short dated calls against it. So I see them short the 12/6 425 call in Tesla.
Okay. So back to the poor man's, which I think is a really pretty good strategy for us. One sec, for the folks. So what delta would that long call be? So if they're trying to make the facsimile of stock, are we really going for the 100 delta call that's deeper in the money, or can it be an 80 delta, a 70 delta? What are your thoughts on that? And how far out would you go? I mean, would you just put it out in a leap and forget about it? I know there's a lot of premium in those babies. So is that wise or not wise? What are your thoughts on where you place this long call part of it? And we'll get to the short in a second.
How short of a put do you want to be?
Okay, so if you have stock, you're short the at the money put all the time.
Correct.
Yeah.
But this trade could go very south if Tesla goes south, right? If you buy 100 shares of Tesla and you spend, right now it's $371, and you spend, $37,000 to buy 100 shares of Tesla. If it goes to zero, you lose all $37,000. If you're long that 295 put instead, sure, you're capitally efficient to the tune of only having to spend sorry, not put the call.
Yep.
That call is a $90 call right now.
Okay.
So you spend $90 instead of $370, $9 grand, 37 grand. And, but you could lose all of that 9 grand if it goes below 295.
Mm-hmm.
Whereas it's at 295, you've only lost 80 over 380 is, I don't know, 12%.
Yeah. Okay.
That's not right, but
So
go ahead. Yeah, I know what you're saying though, Mark.
20%.
Go ahead, Jason. Sorry.
So if they're buying leaps like that, how levered are they? Are they holding the cash aside that, like, is it only 1x, but they're holding the 295 to the side?
By the way, besides the communist, who is they? You talking about the fund manager?
The fund manager.
Okay, sorry. I just want to make sure we're clear on that.
Yeah.
Go ahead.
It looks like the net assets are about 100 billion. Sorry, 100 million, about $1 billion. 100 billion would have been quite the fun.
Yeah.
But their bills, I've just got to add up. They got they sort of have like a bond ladder going out through 2025. It's all relatively short term though. Like 26 is the longest dated. They own 13% in some real long dated, but for the most part, it's short term. So like 90% of this fund is in, 95% of this fund is in bills expiring in the next year.
Mm-hmm.
So they're not very heavily levered at all. They're just,
No. Well, actually, the answer to that question would be more like their covered call is worth, I bet you 100% or no, 95% of the cash is sitting in bills, and they put up margin to own those call spreads. So they only 5% of that would be the margin, call it. And they've got 220 million of long options and 143 of short options because it's expiring tomorrow. Presumably that number goes up, when they roll. But like 20% of the value of their T-bills is in long options.
Got it. So it seems like it's I wrote with the bad marker on the remarkable. That's not good. That's a bad.
But they could lose all of that. Tesla goes below 295 by February, and you're out 22%.
Yeah. But what's Tesla's trading now? 371.
371. Yeah.
So it would have to go down $80 in order to. So what is that? That's almost like
20%.
Yeah. So that's what they're doing. That's interesting.
So let's get back to what would be better. Okay. We don't like the package thing so much. Sounds like, how would you, this is an investment advice, but as an advisor or a trader, let's call it, how would you structure it? If, you probably have to ask the client, what kind of return are we looking for? I would imagine, right? First, risk tolerance, yada, yada.
I think risk tolerance and the more you overwrite, the more choppy experience you're going to have, right? The higher delta or greater percentage of your portfolio, the more that P&L is going to pollute your, equity P&L.
Sure.
I think the first order, simple, do it yourself at home, adjust by delta. That's a much better way to target a call. It's robust across volatility environments, names that instead of just saying, I want to collect 2% a month or 5% out of the money. If you're going to do a naive strategy, hang on to delta as your, the decision-making tool, as your ruler for writing that call.
Is there a honey zone delta, like a 25 delta is a great one, a 30 delta, anything that comes to mind that, I'm trying to make it easy for the intermediate beginner to figure this out. So what's a decent delta, do you think? And I know it depends on implied volatility. I get that, but
I would say 21.7 during the full moon phase and 24 in spring and fall.
I love it. Perfect.
Yeah. If you're approaching the vernal equinox, though, use a 34 delta.
Okay. I get it.
It's garbage night.
No, but in all seriousness, it's somewhere in that range, I think. It's somewhere between 15 at a low and 30 at a high. I think.
Okay. I was getting to 25. That's what I thought it would be, is around 25-ish on average, which is pretty good. And you can clearly, goose it one way or the other based on your risk threshold or some of your beliefs about the product, the underlying product, right? If you're a lifelong believer in something, some people just say, Apple's never going down. I know there's going to be waves, but I just want to be long it forever. Right. So having that income strategy with the covered call, it's going to expire. And, before we close here today, what do you do at that expiration if you're still a believer in the underlying? What if it goes through the strike? Do you let it expire and let it wash out your stock? Seems like there's a tax disadvantage there if you're still a believer, right? Or do you roll it out and up? What are your thoughts there? And then we're gonna have to say night.
I'd roll it. If you still believe it, I'd roll it up and out.
I'm waiting for Jason because I want to make fun of you as a roller. You love the roll.
I do.
Just a little nip and a tuck here. Let's roll this up here.
Yeah, and you agree with that, Mark, as well?
I think I generally do. Yeah.
When would you take? So, because I've had a debate with people about this who don't believe in the roll out and up strategy or out and same strike, whatever. They say let it expire, wash out the stock, start over again. I'm like, wait a minute, don't you pay tax on the long term part of that stock sale when you're assigned? Yes or no?
Yes, and I think it depends on what are you coming to covered calls for. Like you said, in your scenario, if you're the Apple long-term believer, this is the engine of American greatness, whatever, yeah, you roll because you're still, long Delta. Whereas if you're an opportunistic covered call trader, you let it wash. If you're getting long something because you think it's going to pop, an IBIT, for example, that's a great covered call to trade because you're if Bitcoin jumps over 100K, like it did, it's going to rally even further. So that's a good covered call set up to do as a temporary play.
Sure.
That you just take your money and run and move on to the other opportunistic trade.
Okay. Fair enough. All right. Guess what? I got to go. We got to go. That's it. Merry Christmas. Good to see you guys.
We're doing some more shows before Christmas, I hope.
Yeah, I know, right? What the heck?
I'm kidding. We'll do another. By the way, I'm in Vegas next week. So I'm at a conference speaking I can't even remember the hotel, but somewhere. We'll do our show from Vegas on Thursday, if that's doable for you gents and for me, depending on where my travel schedule is. But let's try that. What else? Adayam.com. Up top, Jason D. Lorenzo. damfunds.com, harvestedfinancial.com, Mark Phillips. Don't forget to subscribe to hub.tradier.com. And if you're looking to open an account, which I'm not supposed to say, Tradier.com is where you can go to do that. And we're going to start giving out promo codes for freeness in the very near future. The last thing I'd say is I love getting emails, hundreds and hundreds and hundreds of them. So if you have any questions, send me an email, lex@tradier.com. Super simple. And if you have questions about promos, also let me know in the email. Until then, gents, you guys have a great rest of the week and weekend. Cool?
Cool.
Happy trading.
Happy trading. We're running a
You know how the financial world goes. Here comes the buzzkill. Please make sure to take some time to read this boring disclaimer. We will owe you one.